You're scrolling through your investing app when a stock grabs your attention. Maybe it's been climbing non-stop for months. Maybe a coworker keeps talking about it. Maybe every finance creator on YouTube suddenly seems obsessed with it. And eventually, the thought pops into your head. Should I buy this stock? But here's something most investors never hear. That's actually the wrong question. Is it a great business? Not the important question. Has the stock been going up lately? Also not the important question. Is the valuation ratio low or high? Helpful, but still not the main thing. There is one number that matters more than all of those combined. And chances are you've never calculated it. It's the growth rate that today's stock price is quietly demanding from the business underneath it. Not the growth management is hoping for. Not the growth analysts are forecasting. Not the growth financial media is talking about. The growth that the current market price itself requires. Because every stock price is making a hidden demand. If the company meets that demand, investors are rewarded. If it falls short, investors usually aren't. Over the next few minutes, I'll show you exactly how to uncover that hidden number for any stock you want. And when we run the calculation on 4 companies almost everyone recognizes, the results are probably not what you'd expect. But before we get there, we need to make sure we're thinking about stock prices the right way. Most people look at a stock trading at, say, $135 per share and treat that number like an objective fact. The stock is worth $135. End of story. But that's not really what a stock price represents. A stock price is closer to an agreement. A measurable agreement between a company and the people who own it. Here's what that agreement says. The market believes this business will grow by a certain amount over time and generate enough value that owning part of it today is worth the risk compared to putting your money somewhere simpler and safer. That's what every stock price on every exchange is silently communicating. The problem is that almost nobody translates that message into plain English. That's what we're going to do. We're going to take the stock price and compare it with the actual business underneath it. How much revenue the company currently generates. How large its opportunity really is. How mature the industry might become. And what a realistic future version of the company could look like. Then we'll work backward. We'll ask a simple question. How fast would this company need to grow every single year for today's price to make sense? Not to make investors rich. Not to beat every stock in the market. Just to justify the current valuation compared with the boring alternative of simply owning a broad market index fund. That's the number we're looking for. We'll call it the implied growth rate. Because that's exactly what it is. The growth rate the current stock price is implying, whether anyone says it out loud or not. And this matters for one simple reason. Most of the questions investors are taught to ask are answering problems that the market has already answered. Is the company popular? Is revenue growing? Is the stock expensive? Is everyone bullish? Those questions are already reflected in the price. The market has already baked those opinions in. Your real job as an investor is much simpler. You don't need to figure out whether a company is good. You need to figure out whether the expectations already built into the stock price are realistic. And surprisingly, very few investors ever stop to check. That's where the biggest mistakes usually begin. At this point, you might be thinking, isn't that what valuation ratios are for? After all, that's what most investors are taught. Find a stock with a low valuation multiple, avoid the ones with high multiples, and you've done your homework. Simple. Unfortunately, investing isn't that simple. Now, to be fair, valuation ratios aren't worthless. They can be useful as a quick reference point. The problem is that many investors treat them like a complete answer when they're really just a tiny piece of the puzzle. Let's take one of the most popular metrics, the price-to-earnings ratio. The calculation is straightforward. You take the company's current market price and divide it by the profits it generated over the last year. If a company trades at a PE of 25, investors are effectively paying $25 for every $1 of annual earnings the business produced. That's useful information. But notice what it's actually measuring. It's looking backward. The ratio tells you what the company already accomplished. It says almost nothing about what must happen next. And that's a major distinction. Because stocks aren't valued based on yesterday. They're valued based on tomorrow. Imagine 2 businesses. Both trade at a PE ratio of 42. Most investing websites would immediately label both of them as expensive. Yet the reality could be completely different. The first company operates in a mature industry that's already highly competitive. Its profit margins are near historical highs. Its customer base is mostly saturated. Growth opportunities are becoming harder to find. The second company serves a rapidly expanding market. Its margins are still improving. Its products are reaching new customers every year. And its total opportunity is several times larger than its current business. Same PE ratio. Completely different future. For the first company, today's valuation might require extraordinary performance. For the second company, the exact same valuation could be perfectly reasonable. That's why relying solely on valuation multiples can be dangerous. They make companies look comparable even when their futures are nothing alike. A single number can't capture how different two businesses really are. And there's another issue investors often overlook. What happens when a company isn't profitable? Suddenly the PE ratio stops working. The earnings number disappears. The ratio becomes meaningless. Many younger growth businesses fall into this category. So do cyclical companies during weak periods. Businesses undergoing major transitions often do as well. Ironically, those are exactly the situations where investors need the most clarity. Yet the metric everyone relies on provides almost none. This is where the implied growth approach becomes much more useful. Instead of focusing on last year's earnings, it focuses on the expectations embedded in today's stock price. It asks, what level of business performance does the market already require from this company? That question can be asked whether earnings are high, low, or temporarily non-existent. As long as the company generates revenue, the framework still works. And that's one reason professional investors frequently think this way. They're less interested in what happened last year. They're more interested in what the current price is assuming about the future. Because once you understand those assumptions, you can finally judge whether they're realistic. And the best part, the math is far simpler than most people expect. In fact, you only need a handful of numbers. Let's walk through exactly how the process works. Now let's get into the actual framework. And before you panic at the word framework, relax. This isn't one of those complicated Wall Street models buried under dozens of spreadsheets and endless assumptions. The process is surprisingly simple. Once you understand it, you'll be able to estimate the market's expectations for almost any stock in just a few minutes. All you need are 5 inputs. That's it. Let's go through them one by one. Number 1, market capitalization. The first input is the company's market value. This is simply the total value investors currently assign to the entire business. You calculate it by multiplying the share price by the total number of shares outstanding. Fortunately, you don't need to calculate it yourself. Every major investing platform displays it automatically. Whether you're using Yahoo Finance, Google Finance, your brokerage account, or a financial data website, the number is usually listed near the top. Think of market capitalization as the current price tag attached to the entire company. That's our starting point. Number 2, revenue. The second input is revenue generated during the last 12 months. Notice that we're using revenue, not earnings. Not net income. Not free cash flow. Revenue. We're interested in the total amount of money flowing through the business before all the accounting complexities begin. Revenue tends to be far more stable than profits and gives us a cleaner picture of the company's economic size. Like market capitalization, this figure is easy to find on virtually every financial platform. Number 3, required return. Next, we need a target return. In other words, what annual return should justify taking the risk of owning this stock? For our examples, we'll use 11% per year. Why 11%? Because over very long periods, broad stock market indexes have historically delivered returns in that neighborhood. It's a reasonable benchmark. If an individual stock can't reasonably deliver returns around that level, then investors might have been better off simply owning a diversified index fund and doing absolutely nothing. That benchmark becomes our hurdle rate. Number 4, time horizon. Now we need a time frame. We're going to use 10 years. Long enough for business fundamentals to matter. Long enough for temporary market noise to fade away. But not so long that we're pretending we can accurately predict what the world looks like 50 years into the future. 10 years strikes a practical balance between realism and long-term thinking. Number 5, the mature valuation assumption. This is the only input that requires some judgment. Ask yourself, 10 years from now, when this company is more mature, what valuation would investors likely assign to it? More specifically, what multiple of revenue would the market probably pay? Different industries tend to settle into different ranges. A highly successful software company might eventually trade around 7 or 8 times revenue. A mature healthcare business might settle closer to 5 times revenue. A large retailer could trade near 1 to 2 times revenue. These aren't random guesses. They're based on how mature companies in those industries are valued today. The goal isn't perfection. The goal is simply to use a reasonable estimate of what the business could look like after years of growth. Once you have those 5 numbers, the rest is straightforward. Here's the logic. If you expect an 11% annual return for 10 years, the company's future value needs to be substantially larger than it is today. In fact, after a decade of compounding, the market value must be roughly 2.8 times its current level to satisfy that return target. That's the future valuation we're aiming for. Next, divide that future valuation by the mature revenue multiple you selected. The result tells you how much revenue the company would need to generate 10 years from now. Now comes the final step. Compare that future revenue requirement with the revenue the company produces today. Then calculate the annual growth rate needed to bridge the gap. And there it is. That's the implied growth rate. The hidden growth expectation embedded inside today's stock price. The number investors rarely discuss. The number financial television almost never shows. The number that reveals what the market is actually demanding from the business. To make this crystal clear, let's walk through a simple example before we move on to real companies. Because once you see the arithmetic in action, the entire concept becomes impossible to forget. Let's see what happens when this framework is applied to real companies. Nvidia. Start with Nvidia. The company is now worth roughly $5.3 trillion and generates around $260 billion in annual revenue. Using a generous mature valuation of 8 times sales, today's stock price implies Nvidia must grow revenue at approximately 21% annually for an entire decade. At first glance, that sounds achievable. After all, Nvidia recently reported growth far above that level. But the challenge isn't next year. The challenge is maintaining that pace for 10 straight years from an already enormous base. If Nvidia succeeds, revenue would need to approach roughly $1.8 trillion annually by the end of the period. That's a scale few businesses in history have ever reached. The market isn't simply betting on continued success. It's betting on historic success. Tesla. Now look at Tesla. The company carries a market value near $1.6 trillion while generating roughly $100 billion in annual revenue. Even assuming a favorable future valuation of 3 times sales, the current price implies revenue growth of approximately 30% per year for 10 consecutive years. That's where things become interesting. Tesla's recent revenue growth has been significantly lower than that requirement. Some quarters have improved, but the stock price isn't asking for occasional strong years. It's asking for sustained high growth over an entire decade. To justify today's valuation, Tesla would need to generate roughly $1.5 trillion in annual revenue 10 years from now. That would place it among the largest revenue-producing companies on Earth. Again, this isn't a judgment on Tesla's quality as a business. It's simply revealing the size of the expectation already embedded in the stock. Johnson & Johnson. Now move to a company most investors consider safe and predictable. Johnson & Johnson. With a market value around $580 billion and annual revenue near $100 billion, the implied growth rate comes out close to 13% annually. The issue? Historically, the company has grown far slower than that. Over long periods, revenue growth has generally been closer to mid-single digits. Yet today's valuation assumes a much faster pace for many years ahead. The safe stock is actually carrying a surprisingly ambitious growth requirement. That's something most investors never notice when they focus only on dividends or valuation ratios. In the next section, we'll look at the company that completely flips the traditional investing narrative and shows why high valuation ratios don't always mean a stock is overpriced. Costco changes everything. Now let's look at Costco. Most investors see a PE ratio near 50 and immediately assume the stock is overpriced. Traditional valuation metrics make it look expensive. But when we run the growth requirement calculation, a different picture appears. Costco generates roughly $300 billion in annual revenue and trades at only about 1.5 times sales. The implied growth rate comes out to approximately 10 to 11% per year. Here's the key difference. Costco's actual revenue growth is already close to that level. In other words, the business is currently delivering what the stock price expects. The math and the reality are aligned. And that's the biggest lesson from this entire exercise. A stock can look expensive on traditional metrics while still having reasonable expectations built into its price. Likewise, a stock that feels safe and familiar can quietly require extraordinary future performance. Why most investors never check this. If the calculation is so useful, why isn't everyone doing it? Because almost nobody is encouraged to think this way. Brokerage apps show prices, charts, daily gains, analyst ratings, and headlines. What they don't show is the growth expectation hidden inside the valuation. Financial media focuses on recent news. Analysts focus on target prices. Influencers focus on exciting stories. Everyone talks about what happened yesterday. Very few people discuss what today's price already assumes about tomorrow. And that's important because investing isn't about identifying great companies. It's about determining whether the market's expectations are too high, too low, or reasonable. The investors who consistently make better decisions aren't necessarily smarter. They simply make a habit of measuring expectations before committing capital. Once you start doing that, you stop chasing stories and start evaluating probabilities. And that's where the quality of your decisions begins to improve. So what's the real takeaway here? It's not that every stock is overpriced. It's not that you should avoid individual stocks. And it's definitely not that a single formula can predict the future. The lesson is much simpler. Every stock price already contains a prediction. Before you invest, your job is to uncover that prediction and decide whether you believe it. That's it. Because once you know the growth rate the market is demanding, everything changes. The conversation shifts from, "This company is amazing," to, "Can this company realistically achieve what's already expected?" That's a much better question. And better questions lead to better decisions. The beauty of this framework is that it doesn't tell you what to buy. It doesn't tell you what to sell. It doesn't force you to be bullish or bearish. It simply translates the market's expectations into a language you can understand. Sometimes you'll find a company where the expectations seem perfectly reasonable. Sometimes you'll discover the market is demanding something close to a miracle. And occasionally you'll find opportunities where the expectations are lower than what the business is already delivering. Those are the moments worth paying attention to. So before your next stock purchase, take 5 minutes and run the numbers. Look beyond the headlines. Ignore the hype. Forget what everyone on social media is saying. Ask one simple question. What does today's price require this company to accomplish? Then ask yourself, do I genuinely believe it can get there? If the answer is yes, invest with confidence. If the answer is no, walk away without regret. Because the biggest investing mistakes rarely come from bad companies. They come from paying prices that assume impossible futures. From now on, don't start with the story. Start with the expectation. Run the number first. Make the decision second. That single habit won't guarantee success. But it can save you from some of the most expensive mistakes an investor can make. And over decades, avoiding major mistakes is often what creates extraordinary results. I'll see you in the next one.